Thank you for joining me. I want to talk today a little bit about the ethical ramifications of the subprime mortgage crisis and the subsequent Great Recession in the United States and then the recession around the world in 2007 and 2008 and 2009. It's a very interesting story, and I think it's especially interesting for uh, the field of business ethics because of what it says about the ethical ramifications of risk taking and of loosening parameters to allow people to take risk, perhaps levels of risk far beyond what is required by the particular goals that they're trying to accomplish. So there are several different actors or players in this story, and we can separate them into at least three categories: the government, lenders, that is, mortgage originators, credit unions, banks, and other lenders, and ordinary citizens or mom and pop. So let me start with the government. The government, without a doubt, played a role in the development of the subprime mortgage crisis, the Great Recession, and the ethical ramifications of those crises. In the late 1990s, in the United States under the Clinton administration, it was typical for the the policy stance at the time was for the government to want to encourage home ownership. And this has been a long-standing American dream, to own your own home. And the government, times were good, the government was running a surplus, and the government wanted to encourage home ownership among Americans who might not otherwise be able to, under normal circumstances, own their own homes. And so the government uh, allowed a particular act, the Glass-Steagall Act, to lapse, and in doing so, and also by means of some other legislative machinations, the government encouraged mortgage lenders to loosen their requirements for originating a mortgage and to allow persons to obtain mortgages who otherwise would not necessarily qualify for a mortgage. Now, when you buy a home, it's a secured loan, and as a secured loan, the home itself serves as the collateral for the loan. Another example of a secured loan might be an auto loan. An unsecured loan would be a credit card loan, which typically charges a higher level of interest because it's not secured by some form of collateral. Auto loans and home loans do have collateral that they are secured by, and as such they charge lower levels of interest. But when you apply for a home loan, you have to qualify in the eyes of the lender and by the requirements and standards that the lender uses to sift and filter those mortgage borrowers that the lender wants to have on their loan book. Okay, and usually the way that they do this in banks and credit unions is by means of credit scores. A good credit score might be something like 750 or above. 800 certainly would be an excellent credit score. A bad credit score might be something like 600. And what the banks and credit unions do is they try to ascertain your responsibility as a borrower and the likelihood that you will repay the mortgage loan that you are trying to originate with them by means of your credit score. Now, let me get back to the main narrative. Basically, what the government did was it guaranteed in the late 1990s to the lenders at the time that it would backstop their lending practices if they would originate mortgages to so-called subprime mortgage borrowers. These are persons who are not prime material or prime candidates for mortgages, but persons whose credit scores are a little bit lower and who are considered subprime. Now, their credit scores are lower for a reason. They are considered subprime for a reason, and it is because they are riskier borrowers. They bring with them a higher percentage likelihood of defaulting on their loans. Now, the government wanted to encourage home ownership among these borrowers, partly as an achievement of the American ideal for them. Times were good. partly so that equity could be accomplished in the housing market for persons coming from underprivileged socioeconomic classes, and so on and so forth. And basically, what this brought about was this some reckless behavior among the second group of agents. So the government is the first, and the second group of agents is the lenders themselves. These lenders began to engage in reckless behavior between the years of about 1998 or so and about 2007. Taking the government at its word, when the government promised to backstop by means of tax incentives and by means of financial guarantees for loans that went awry. When the government promised to backstop mortgages originated to subprime borrowers, these lenders took the government at its word, and they began lending all sorts of subprime borrowers mortgages in order for these persons to obtain homes. And some of the lending practices got really quite reckless. They got very, the lenders got very greedy. They realized that the government would support them through tax incentives if they got greedy in this way and began lending to persons who didn't otherwise qualify for these loans. And before long, by 2005, 2006, and then especially in 2007, a large number of subprime borrowers had been put on the loan books of mortgage origination companies, of banks, of credit unions across the United States. And these were subprime borrowers who ultimately were highly risky as mortgage customers. Now, there is a third set of agents, group of agents in this story, and that is mom and pop. And mom and pop were greedy. Mom and pop in this story did not understand the ins and outs of the financial instruments that they were employing, the mortgages that they were taking out, the kinds of exotic financial instruments that they were being offered by mortgage companies, by banks, by credit unions. And mom and pop overextended themselves. They ran up too much debt. They got greedy in wanting too much house. It's typical for a lot of Americans to want too much car or too much house, to buy more than they actually need, and to try to make it up in the future by means of greater income so that they can pay off the debt in time. Now, mom and pop overextended themselves. They took out exotic mortgages, like I mentioned. A standard mortgage is a fixed rate mortgage. Sometimes you'll see a varying rate mortgage. Sometimes you'll see other kinds of mortgages where you only pay the interest, or mortgages where you pay a little bit now and a lot later, a balloon mortgage. There's still other kinds of exotic instruments. Mom and pop were offered these instruments by greedy lenders who got reckless and wanted to put mom and pop on their customer docket. And mom and pop did not understand what was going on to them, going on in this sales process, and they agreed to a lot of these loans that ultimately they began to be unable to pay. Now, what happened to touch off the subprime mortgage crisis was just a large number of people simultaneously, mom and pop, simultaneously defaulting on their mortgages. These were subprime customers, persons unable to pay for the loans that they took out, or unwilling to pay for the loans that they took out through either job loss or through the inadequacy of their income to pay for these loans, or through behavioral mistakes. And when you default on a mortgage, the bank forecloses on your home. A foreclosure process is basically a seizure of the home process, where the home, the collateral for the loan, comes to be in the possession of the bank. Now, a bunch of people began defaulting on their mortgages simultaneously, because that, if you look at the statistical models, 2007, 2008, that was about the time that, given the loan books that the banks were running, a bunch of people would default on their mortgages simultaneously. And when people did this, the banks ended up with a large number of foreclosed homes. Now, this quickly spiraled out of control. It was a situation that was very quickly snowballing into a massive economic problem. When a large number of banks all have foreclosed homes at once. What they do is they want to flip these homes. Banks are not in um, the rental business. They are not in the home selling business. They are banks. They are financial institutions who make their money from loans, not from the actual possession of the actual houses themselves. And so banks want to flip these. Usually they lose some money doing so, but they're much happier flipping these homes back out onto the market in return for just getting them off of their books. Now, what happens, unfortunately, was when a large number of lenders all flipped their foreclosures simultaneously, the supply greatly exceeded the demand in the housing market. And when that happens, the price point, of course, plummets because there are many more sellers than there are buyers. And the value of everyone's home began to collapse. And when people are struggling to pay their mortgages, like all the people who eventually got foreclosed on, they tend to give up other kinds of consumer spending. They tend not to buy luxury items or items that they might, under normal circumstances, be willing to spend money on. And this is because they're trying to service their debt. Now, this brought about a snowball effect that actually eventually tanked the entire American economy. About 2/3 of the American economy these days is driven by consumer spending. And when a large number of consumers simultaneously being unable to make their housing payments or finding their houses worth a lot less, and so being unable to sell their houses at a profit, and so needing to try to find some other way to navigate their financial circumstances, they cut their spending as a result. When this is all happening at once, what happens is the entire economy begins to tank. And in the end, what occurred was the Great Recession. The recession of 2008 was considered the most severe recession in really 75 years since the Great Depression of the 1930s. And it was the result of really a reckless set of circumstances where lenders, mom and pop, and the government all engaged in risky behaviors which are really hard to justify ethically. In business, when you take on risk, it is usually done ideally in a way that is efficient and that is rationally conceived. And if you take on too much risk, or if you engage in reckless behaviors, you enter into ethically precarious scenarios. They are ethically precarious because it is very dangerous for you and for your business to engage in such risky behaviors. And in another video, I'm going to talk a little bit about how the government and the country, the United States, resolved the subprime mortgage crisis and ultimately the Great Recession. They did so in a way that is very morally sketchy and dubious, but it was ultimately successful. At any rate, though, as for the causes, there were three agents: the government, lenders, and mom and pop, and all three agents share blame, in my view at least, for how the subprime mortgage crisis came about.